Autoline Spotlight is presented by Ally. Do it right. On this episode, wholesale financing.
I want to thank you all for joining us on this special edition of Autoline. We're going to be talking about wholesale financing at dealerships. As you're all aware, dealers do a lot of lending with retail customers, but there's a lot of financing that goes on at the wholesale level. That's today's topic. Joining me for that discussion are Tom Bennert, the head of Ally's Commercial Auto Chief Risk Office. He's also the chair of Ally's Commercial Auto Credit Committee. Also joining us today are Sam Slaughter. He's the owner of Sellers Auto Group, which includes Buick, GMC, and Subaru. And my colleague and friend, Steve Finlay, is a senior editor at WardsAuto. Well, I'd like to thank you all for joining me here today.
Thanks, John.
Tom, why don't I start out with you? Interest rates are starting to tick up right now in the United States. What's the impact and how is the industry responding to this?
Well, I think, John, the industry is responding pretty well. I think it's important to keep things in context. The Fed started moving interest rates up in December 2015, and they've moved rates up 4 separate times for 100 basis points since that time. But still, from a historical perspective, interest rates are still quite low. The prime rate is currently 4.25%. If you go back to early 2008, the prime rate was at 5%. So while rates have come up most recently, they're still, by historical standards, quite low. So again, dealers in this environment, despite, some higher interest costs, they're doing quite well, to date.
Sam, are you seeing an impact?
Well, I completely agree with Tom. If you look at the historical, I've been around this business a long time, and 4.5% prime is pretty darn good. So yes, they're going up. I think we've enjoyed a wonderful run here of low interest rates, but we also understand that's part of the cost of doing business, and you can't make a decision on inventory based solely on the interest cost. You have to make it based on what you think you're going to sell.
At what point do you start getting nervous about interest rates?
Well, I would say this. I mean, I think that we're more careful these days with inventory. As things fluctuate, you have to be more careful. But I don't see a massive pullback in inventory, until rates get, extremely high.
I think it's also important to note if interest rates are going up, that typically means that the economy is doing well. And
right.
the Fed
which
is
means
taking
we're going to sell more cars,
That's
which
right.
means we don't want to short ourselves.
It means dealers are selling more cars, the consumer is still confident, and
yes.
The economy is doing well.
Yeah, I agree.
Are you seeing dealers lower inventory levels, though? And if so, which brands are doing it?
Not so much, actually. I mean, on a year-over-year basis, I think if you look at most of the OEMs on a day's supply basis, they're higher this year relative to last year. GM in particular, Ally does a lot of GM dealer financing, and GM finished July at 104 days supply of inventory on the ground, which is quite high and up from where they were at the end of 2016 at a 71-day supply. Now again, GM has publicly stated there are reasons for that. They're retooling a number of plants, shifting capacity from passenger cars to trucks and crossovers. And they expect to get back to kind of a more normalized level by the end of the year. But I'd say generally as the sales in the industry have pulled back a little bit this year, we're going to start to see, a more careful balance between production and demand. And ultimately, we expect, a lot of the OEMs to, level off their production levels and for inventories to normalize.
Well, the average inventory level is about 69 days, which is high. It's not red alert high, but there's basically only a couple ways the OEMs can reduce those inventories. One is to cut production, and the other is to incentivize sales, or both. Which do you think they're going to do the most? Well,
I think, as Tom mentioned, in GM's case, we have 3 major product lines at Buick and GMC that are undergoing 100, all new product. So we had to, in order to get through that 2 or 3 month conversion, we had to stock up on the last of the old product. And so for us, we are getting back to what I would call normal. And by the time the old Enclave, for example, is pretty much sold out by October or November, we'll be getting the brand new Enclave, and that will level itself out. So there's a certain amount of, I would agree, there's a certain amount of maybe maybe the industry is slowing down, but our sales are up 40%, so we're not slowing down. We have high inventory because we needed to make sure we had the coverage.
Well, and I did a story recently on the dichotomy of, yes, the inventory levels are high. Again, not anything to be super concerned about. So that has to be managed and addressed. On the other hand, American consumers love lots full of cars.
Right.
They like to walk the lots, they like to see the product. And so what is the balance between satisfying that desire of the consumer to have this wide selection in front of them and yet keep
Steve, if
management?
If I knew that
inventory.
balance, I would be a much happier man. Back when I was a sales manager, that was the biggest worry, was you're balancing between what you should order, what your dealer, now in my situation, telling them, oh, you can't order this, you can't order that. The biggest problem is what you mentioned, and that is the customer wants the car that they want, and they want it now. And they know that if I don't have it on my lot, I've got a dealer trade for it, and they can find it on the internet. They know where it is. And as crazy as it sounds, I have 900 cars in my inventory. A month ago, I had 900 cars in my inventory, and we still dealer traded for 30% of our sales. It just blows my mind. So there isn't a good way to understand that balance. You're taking a gamble, every day, but that's this business.
And a lot of consumers mistakenly believe that dealers don't own those cars. They think they're the middleman and basically the OEM owns them and you're just doing the deal. You buy
that would
the
be
cars.
Nice.
That would be great for you guys. But there is that need for the dealer to manage that inventory.
Absolutely, yeah.
Yeah, and that's one thing, again, we keep a close eye on is, again, that's a tough balancing act, as Sam just said. But ultimately, we don't want to get back to a time like prior to the Great Recession, especially with the domestic automakers, where it's overproduce and then have to, spend a lot on incentives to get the product moving.
That's really cheating the future.
And that's, you can get into a vicious cycle, and ultimately that harms residual values and the brands over time. Again, we've seen great discipline since the Great Recession by all of the OEMs. We expect that to continue, but it's something at Ally, at least, we continue to keep a close eye on.
I would 100% agree with that, and where I would cite General Motors on that is, in a positive way, is probably 5-6 years ago, GM said, we are going to really make sure that our company can fluctuate between sedans and crossovers and pickups and what have you. And I'll tell you, they are. Sedans are really tough right now, and GM's throttled back on producing them, but I can get all the trains I want. And so I think I hand it to GM for really understanding that, and maybe other manufacturers too, I'm sure, I don't know. But on the GM side, they're actively managing that so they don't have to incentivize cars people don't want.
Right. What are you seeing on the used side of the market? We've been talking all about new cars, but what are you seeing happening with used cars right now?
Well, I would say the used car market is great. We have done a great job here in Detroit, where used car sales, because of the incentives and the employee business, used car sales have been tough. We're doing really well with used cars at both stores, and it's just because we focused on it and concentrate on it. And
of course, your sales on the new side are up real
well, yeah,
too.
right.
You're doing great. Tom, what are you seeing nationwide in this regard?
I mean, we're seeing some pressure on used car pricing. So again, there are a lot of off-lease vehicles coming back into the marketplace, so the supply is going up, and that's putting some pressure on pricing, but overall demand and volumes still at very healthy levels. So from a dealer impact standpoint, at least how we view the dealers, we haven't seen any adverse impacts at all.
Well, the off-lease vehicles are coming back in waves, and they're going to keep coming back. So how much inventory management to its software is needed to control that and make sure you don't get burned?
I mean, I think it's, to some degree, a similar story to new, and as Sam said, it's a tough balancing act. But again, when we view dealers and performance of the dealers, we look at how they manage their inventory, how they turn both new and used, and again, we watch for dealers who start to stockpile used vehicles and aren't able to sell them, and that's not a very good predicament for a dealer to ultimately find themselves in. Again, the significant majority of the dealers in our portfolio manage their inventories very well. They turn the vehicles appropriately. But again, that's ultimately what we all guard against. If there's a more significant accelerated drop-off in the market, are you well prepared to handle that? And that's what we look at.
Are the days of the used car guy with the gut feeling about what to stock over?
Over. 100% over. And you know, it's an interesting process. We started on that process about 5 years ago to kind of really boost up our used car sales and also kind of get rid of that old mentality. And not in a degrading way at all, but I had some managers who says, I don't care what the machine says, my gut says, and that will kill you. It really will. And managing used car inventory is a science today. You have to have the discipline to get out of cars at the right time. The biggest problem that we see is as values soften, you get stuck with a car that's 85 or 90 or 130 days old, you're in deep trouble. So I tell my guys all the time, it's like running a vegetable stand. They're rotting every single day, and you got to get rid of them before they go bad.
What do you think's behind that mindset of believing your gut over the data?
Well, because for years we didn't have the tools. You know, you had your black book and you had your what you sold the car for last month, and it was gut feel. But a lot of this business, new, used, service, body shop, that you used to be able to do in gut feel, today you can't. You'd have to take advantage of the technology that's available to us.
I want to ask you about regulation. We know that on the retail side, car dealers are probably the most heavily regulated. The general public's not aware of this, of how heavily regulated that dealers are. I'm wondering, does that apply on the commercial side as well?
I think, John, my short answer would be not as much. I've been in this business for about 30 years now, and frankly, how we do commercial lending today for the dealers hasn't changed really significantly over the years in terms of a regulatory environment. Certainly much more focus and attention on kind of the consumer side of the business, but you know, not a whole lot has changed on, you know, kind of the commercial side or the direct lending to dealers.
Now, this gets in a little bit about retail lending, but what about the subprime segment? How much of it is there to be worried about? There are reports that there's a bubble about to be burst. The delinquencies are up. What's your take on that?
Yeah, I mean, I think on the consumer side, again, much more of a spotlight and regulatory focus, and also just a market focus of, you know, did lenders get too aggressive in the last couple of years at the bottom of the market?
Did they?
You know, my opinion, I don't believe so as a whole. I think there may be certain players that, you know, have had to pull back considerably or exit the market. Maybe others will follow. But I don't necessarily buy into the fact that there is a bubble getting ready to burst in subprime auto. I think a lot of people have tried to draw parallels to the mortgage business from the Great Recession. And I don't buy into that theory.
Well, they're very inapplicable, right? The analogy between mortgage and auto.
I think a lot of it is just, again, you know, I think credit has pulled back a little bit, say in 2017 versus 2016, but I still think the credit environment overall still feels pretty healthy. You know, at least we expect the rest of 2017 to finish that way.
Sam, what about
I would tell you that in addition to that difference, I think that the subprime market today is very different than it was 10, 20 years ago.
In what way?
In two ways. First of all, after the Great Recession, I get to call it that because I wasn't around for the first one. None of us were. What used to be subprime is people who were just down and out. What became subprime is somebody who lost a job or had a medical problem or got divorced, or, you know, and they might live in our neighborhood, but they're now subprime. So it's a very different profile of a buyer. And so we decided to jump into subprime about 7 years ago, and we've been very successful at not only getting the right buyer, but finding the right lender. But we also go through an education program with these customers, and we tell them the fastest way for you to get your credit repaired is your cell phone bill and your car note. And if you pay those two, then the next time you buy a car from us, you're going to be regular credit. And a lot of that happens. The other thing I think is vastly different is think about the cars that we used to sell, or dealers used to sell, to subprime customers 20 years ago. You know, at 80,000 mile, you name the brand, was a pile, right? Today, an 80,000 mile car is just warming up. I mean, our cars are so much better, and so one of the reasons that I thought getting into subprime now would be better risk, and I still believe that it is that you sell a customer a car that they're actually going to be able to drive for the 5 years they're making payments, and they're going to make the payments.
Right, and when the car stops, the payments stop.
Absolutely, and why wouldn't you?
Let me ask you a real quick question, Tom, about blue skies and commercial lending as it applies to dealers buying other dealerships. How active is that, and also what about the facility improvement plans that a lot of dealers are facing?
Yeah, I mean, if you look at like Ally's, our dealer loans, so our non-floor plan lending portfolio, the size of that portfolio has more than doubled since 2009, 2010.
Wow.
And again, coming out of the Great Recession, as Sam can attest, I mean, dealers, as the market got better and stabilized, dealers needed to spend money on facility upgrades or constructing new facilities or just additional working capitals to support the growth in sales. Or there's been a lot of consolidation in the dealer space throughout the U.S., so dealers buying other dealers. So again, we are active in that type of financing. We think it's a great complement to the floor plan lending, and you can't really do one without the other. Again, if you look at 2016, it was one of the top years in terms of number of transactions in the marketplace from a buy-sell perspective. I think 2017 has started off very active as well. And we're in that business, and we tell dealers all the time, if you're interested in buying another dealership, we'd like to help you. In terms of the facility upgrades, a lot of the OEMs coming out of the Great Recession had those requirements and mandates in place for their dealers. So I think if you look at most dealerships, they look spectacular today. And so I don't know that there's a whole lot more to spend. Certainly certain dealerships, certain locations, there is, but my guess is at least most of that activity might be behind us, at least for a little while.
And Sam, you get the final thought on that. You're going to be expanding, you're going to be improving facilities, or have you got...
Well, John, I did my huge expansion the day before the market crashed. So thankfully, Ally financed it. I got it done before. But that was a big problem. We built our new whole showroom when we were a Pontiac and Buick and GMC dealer, and Pontiac was 65% of our business, and 6 months later Pontiac was gone, and so ouch, was a big problem. But I agree. I think the manufacturers have really set the course for what these expansions needed to be, and most dealers have completed those, and now it's a matter of tweaking and making sure they're up to snuff.
Real good. With that, we're going to conclude this discussion. I want to thank all of you, though. Tom Bennert from Ally, Sam Slaughter from Sellers Group, Steve Finlay from WardsAuto. Great discussion here. And if you've liked this discussion, stay tuned. We've got more of these coming.
Vicky from Ally keeps finding new ways to earn my loyalty. First, it was a custom proposal to help grow our business, and now...
Jerry!
Is that your car? No, it's hers.
What do you think of the cape?
At Ally, we're the right amount of obsessed with our customers. Ally, do it right.